A man walks into a bank and deposits $1,000. Nothing unusual. By the end of the day, that same $1,000 quietly turns into $10,000, sometimes more. No printing press, no gold, no new wealth created. Just numbers, expanding. And almost no one notices. This isn't a conspiracy, it's how the system is designed to work. And once you see it, it becomes very hard to unsee, because it changes how you think about money forever. Right now, most people believe money comes from one place. Governments print it, central banks control it. That's the story. But that's not where most money actually comes from. In modern economies, around 90% of all money is created by private banks. Not coins, not paper, just entries on a screen. Which raises a strange question. If banks can create money, what exactly are they creating it from? Let's slow this down. Imagine you deposit $1,000 into your bank account. To you, that feels like your money is sitting safely inside the bank, locked away, untouched. But to the bank, that deposit is not just your money, it's their raw material. Because the moment you deposit that $1,000, the bank doesn't just store it, they use it. Specifically, they keep a small portion and lend out the rest. Let's say they keep 10% as reserves. That's $100. The remaining $900, they lend it to someone else. Now here's where things get interesting. That $900 doesn't disappear from your account. You still see your full $1,000 balance. At the same time, someone else now has $900 to spend. Two people, one original deposit. Total money in the system, $1,900. And we're just getting started. Because the person who receives that $900 will likely deposit it into another bank. That bank keeps 10%, 90, and lends out 810. Now the system shows 1,000 plus 900 plus 810. That's $2,710 from an original 1,000. No printing, just lending. This process repeats again and again, each time slightly smaller amounts, but still adding up, until that original $1,000 quietly multiplies into something much larger. This is called fractional reserve banking. But the name makes it sound more complicated than it really is. It's just this. Banks are allowed to lend out most of the money deposited with them, while still promising everyone full access to their funds, which works perfectly. Until it doesn't. Because here's the uncomfortable part. The system only functions as long as most people don't ask for their money back at the same time. If everyone did, the money simply wouldn't be there. Not because it was stolen, but because it was transformed into loans, homes, cars, businesses. Money that exists, but not in the form you expect. Now you might be thinking, okay, but banks can only lend out what they receive, right? Not exactly, because modern banking goes one step further. Banks don't just multiply existing money, they create new money when they issue loans. Let's say you walk into a bank and get approved for a loan of $50,000. The bank doesn't go into a vault and hand you someone else's deposit. They simply type $50,000 into your account. That's it. Your balance increases, and simultaneously a loan is created on their books. New money has entered the system. Out of nothing, except your promise to pay it back. And this is where things start to feel almost absurd. Because the money didn't exist before the loan, and yet you are required to repay it with interest, which raises a deeper question. If all money is created as debt, where does the extra money come to pay the interest? The answer is, it has to be created too, through more lending, more debt, which means the system doesn't just allow debt, it depends on it, constantly expanding, always needing more borrowers, more loans, more money creation. And when that cycle slows down, things break. You can see this pattern in every major financial crisis. When banks stop lending, money creation slows, businesses struggle, people lose jobs, spending drops, and suddenly there's not enough money in the system. Not because resources disappeared, but because the flow of newly created money dried up. Then central banks step in. Lower interest rates encourage more borrowing, sometimes create money directly, trying to restart the cycle. It's like a system that can't stand still. It either grows or it cracks. Now here's the irony. We're taught to think of money as something solid, stable, reliable. But in reality, most of it is temporary, created when loans are issued, destroyed when loans are repaid. Money is not just a store of value, it's a moving system of promises. And banks sit right at the center of it all, creating those promises, expanding them, contracting them, all while appearing to simply hold your money. And to be clear, this system isn't random. It has benefits. It allows economies to grow faster. It funds businesses, homes, innovation. Without it, modern life would look very different. But it also comes with risks, because when money is easy to create, debt becomes easy to ignore. Until it isn't. Until repayments slow, defaults rise, confidence drops, and suddenly the same system that created abundance starts pulling money back out. Quietly, relentlessly. And that's when things feel like they're shrinking, even if nothing physical has changed. So the next time you check your bank balance, it might feel like a fixed number, something real, solid, owned. But in truth, it's part of a much larger system, one where money is constantly being created and destroyed, where your deposit is someone else's loan, and the stability of everything depends on one fragile assumption, that most people won't ask for their money at the same time. Because if they do, you don't just have a bank problem, you have a system problem. And the real question is not whether banks can create money out of almost nothing. It's this: what happens if one day that almost nothing stops working?